Welcome back to Uncontested Investing. I'm Tim Harrods. Thank you so much for swinging back by today. Today, I don't really want to admit it, is a really special guest, Scott. His name's Scott Horne, one of my oldest mentors in the business. But just remember, if you're listening, click down below, subscribe, like, comment, give us a review. Let us know you're there. Let us know what you like. Scott.
What do you mean by oldest? Is that like longevity or age-wise or both?
Well, we were talking before the show. I am now the exact age you were when we became partners at Sprint Partners LP. You were 45 and I was 25. And now I'm 45 and you are, the math would say,
Hush.
eligible for...
Hush.
Oh, okay. Scott, thank you for being here. It means a lot to me. Why don't you just take a minute and tell everybody a little bit about yourself?
So
A minute.
So I start off with, we are real estate and title attorneys. Horne and Associates PC is the law firm. Our new title company is First Option Title, a direct operation. We limit ourselves in those industries to the investor world primarily, work in the creative finance world heavily throughout Texas and nationally. Besides that, like yourself, we are a major investor in the Texas marketplace, buy, fix, and hold, typically with seller financing, asset-based lenders. We're back in the home building business. So we're more or less vertically integrated within the scope of the real estate investment industry with a primary focus today on creative finance, owner financing under the banner of theownerfinancenetwork.com.
So when we first... Oh, I'm not going to get into
Did I really do that in a minute or less? I don't ever do that.
I know. Believe me, I know. How many afternoons I had to sit on your couch and wait for you to stop talking so I could go home. Anyway, the first segment every week is the bluff, the bottom line up front, because, we're all attention deficit these days. There's someone out there listening. They're going to get a phone call or stop at a gas station and forget to turn it back on. Maybe we've bored them up to this point. But take up to 2 minutes. Tell the audience the most important things that you're seeing in today's economy, things you think people should be doing, things you think people should be avoiding, and ultimately just kind of the most important things that you want people to know. Good to go?
Good to go.
Go.
So first and foremost, Tim, I think that the investor in the marketplace needs to realize that everything has changed. Going back a year ago, the average homes in DFW were going for 80, 82 cents on the dollar, sometimes a little bit higher. Today, financially, you cannot do that. I took a moment, ran some numbers with current bank rates, because in the investor community, if you're in the buy and hold game, whether it's rental property or mortgages, where it might be, or owner financing, bank rates have gone up from what used to be 5 to 8.75 and maybe to 9 forthcoming this week. We'll see what happens with the Fed. What that simply means is financially, what you used to be able to buy and finance at 80 cents on the dollar is now about 69 cents on the dollar to break even dollar for dollar. So that means you have to buy your homes for less money. And so you want the investor to think through this a little bit. You've got to get out of a year ago and realize things are happening. You have to also think that what could happen in our marketplace. I go back to 08, 09 when the world crashed around our ears in this business, and most of us weren't expecting it until wham, it happened. And so it's a change of philosophy from the investment scenario. I think the wholesalers are going to have a more difficult time because investors have to buy for less money. There may be some out there who will still pay what we call stupid money, and we see that at the auctions all the time. But I believe we have to change our thought process. We have to be cognizant of what's going on in the environment around us. We have to anticipate what could happen, because anything could happen forthcoming. And then I see another big shift in the investment world where maybe the cash deals are going to slow down quite a bit and the terms deals are going to pick back up again. And it's learning different ways to create opportunity where it's not just buying equity like the days of old may have been, but maybe now we're going to look at buying cash flow. And I think those are the primary emphasis that an investor in today's marketplace needs to be thinking about a little bit.
Well, I don't tell you this often, but you're a fairly smart fella.
I have days.
When I first met you 20 years ago, your primary company was Dash Property Company, Dave A. Rant and Scott Horne. And
There's other acronyms, by the way. We won't go into those.
oh, I know. And Acquisition Funding Source, AFS. At that point in time, we were borrowing money from banks at 9.25, prime plus 1. You were loaning money through AFS at 18.2, if I remember correctly.
Those were the days, weren't they? I miss them terribly.
Well, you just said in the bluff that we're getting back to those days, so I guess you don't have to miss them for long.
So AFSs, became funding partners back in those days. But there's a difference, though. And I agree with the rates. And I tell a lot of people, we're getting back to normality in the marketplace a little bit. The underinflated rates we've had for so long, had to go away. We all thought they'd go away years and years ago, but they kept them underinflated. Look where we are now with this. And so, but the difference today versus what it was then is property values have gone up substantially. Property taxes have gone up substantially. And when you run the same math, what you're doing is you're pricing the average buyer out of the market. In other words, the monthly principal, interest, tax, and insurance payment, if you're running the old numbers the way we used to do it, let's say in the creative finance world back then, 12.5 interest rates, 13. With the property taxes where they are, insurance rates higher, and the sheer cost of the homes, it's crazy. You can't do it. And so that's what I'm thinking is going to drive the investors to buy houses at a lower price and drive the pricing down a little bit in the marketplace. Now, I get what the consumer is going to do out there who's buying the traditional retail deal, but Tim, look at the mortgage rates right now. They're way up there. And
Not historically.
No, not historically by any means. But from where it was just a year ago to today, right, it's a big quantum shift in that marketplace.
So February, the report's out, was the first time the median home price in the United States went down year over year in 11 years.
Well,
and they're saying March will probably be about the same. And then in my mind, I go back to hearing you tell me about Kerbo Horne.
That's an old name.
And when I've listened to you for 20 years. You tell the same, you're out of stories. We're talking about days where you said you had a pager and a roll of quarters, and when someone would page you, you had to go find like a 7-Eleven to make a phone call to see what the office needed.
And Tim, you've got a great memory.
I do. I'm a student, and I try to avoid the mistakes that others made. But you started buying houses right in the late 80s, if I remember correctly?
Late 80s, early 90s, yeah.
Can you and that's the last time we had bank collapses. I mean, this is the last time that, a lot of things happen. Can you just take a minute, and we'll get into kind of today after the first break, but can you just take a little bit of time and maybe talk about the evolutions of the housing market that you've seen in your very long career, esteemed career, and maybe, I don't mean to put you in the spot to predict, but talk about the ways you're guiding your company, because you're a lender, you teach people owner finance, you're a service provider as a title company and an attorney, but you also, we have an owner finance note partnership where we buy notes, and you're actively buying and rehabbing and renting and owner financing. So you're like, I didn't bring somebody that used to be an investor. You're still a very active investor through your company. So could you just take a minute and take us back to when you started, talk about the different things you've seen and kind of how you think maybe the next 6 to 12 months plays out?
Tim, you go back to the late 80s, early 1990. We're coming out of the recession of 85, 86, 87, 88, when the RTC came into play, Resolution Trust Company. The commercial world was a bloodbath. Everything changed, just boom. But we were able to buy homes back then for $15,000. That $15,000 home today that had a retail value of maybe $45,000, for instance, $230,000. And you look at that and you go, get your head around those numbers. It is so hard to watch those stair steps change along the way. And yes, back in those days, the rates were coming down from being very high along the way to that 8, 9, 10% interest rate. You know, my first home loan on my current home I'm in was 8.5%, which I thought was a great deal. And 2 years later, I refinanced at 6, and 2 years later, I refinanced at 4. And it was worth paying the fees to do that because of the math. So, but at that time, property taxes were a bit less, and the value of the homes were less. Things worked very well. Also, we didn't have the advent back then of the internet. And so we were out hustling deals the old way. We were hunting for multiple listing, advertising, things of that nature. And much, much less competition. Because as you know, everybody today wants to be an investor. Everybody wants to be in the game, whether they know the business or not. And they go online and learn through the internet, and they're overnight experts. So we go through that, and one of the things you learn in I'm an old commercial guy from the 80s for a while, and just in the business, is they say that when the market turns, you can feel it. And so it did turn in the late 1990s, and you go, holy cow, that house that we were buying for $15,000, all of a sudden we're buying that exact same house for $40,000, $45,000. And you're going, what the heck just happened?
Right.
And I get it. If you take advantage of the marketplace at just the right time, you can do well. But who knows? Who has that crystal ball, right? Mine's always in the shop, damn it. And I've tried to be consistent over the years. And so you had to turn at that point in time. Then we roll into the subprime era, right? And prices are inching up. And now anything goes. And no one cared, it seemed like, in the industry. And you can see what happened along the way. I like to use the example of a lady coming into our title office to refinance, or she was buying a home. And at that time, a $300,000 house today is probably $6 million. It was her primary residence. A month later, she comes in to buy another house in the same neighborhood as her primary residence. You reach out to the mortgage company to tell them this, they don't care. 30 days later, she does it a third time, and I'll bet you anything, all three of those houses got taken back into foreclosure. And you see the quantum shifts out there. And what you have to do in our industry is you have to understand, learn from the past, right? They always say that. You know, you're a Marine, and militarily, you have to learn from the past so you protect yourself in the future. Same way, I think, in the real estate industry, we have to think forward, but we also know what happened back then and how things are going to transact. I get inflation. It's always been there. It's going to go up. We're in a hyperinflation stage right now. That's driving so many things different, like the price of construction of these homes. You know, paint that used to be $8 a gallon is $45 a gallon. It's amazing. And will it ever go back down again? Don't know. But you watch the evolution. And what I found interesting was, because we learned how to play we'll call it the note game, where we would sell mortgages into what's called the secondary marketplace. And as the price of houses inched up, so did the price that they'd buy our notes at inched up. And the spread, as I call it, was always the same, whether it was up or down. It stayed fairly consistent as you go back and look at it historically. And I still see that today a little bit as well. So you watch the houses as they were very inexpensive back then. There were very few people playing the game that we play or you play in this industry then. Hard money didn't even exist back then. It was private lending. That term wasn't even out there. I'm not sure exactly when it evolved in the early mid-1990s and it came into play. But you watch how the properties increased in value, and it turned in the mid-late 90s. It turned again in the early mid-2000s, just like it did again here, a few years back when the market just went almost vertical for a while. But nothing stays that way. It can't survive. And interest rates kept driving down, and as those rates drove down, it drove the price of houses up because you could afford more than the same amount of money. You just have to be forward thinking. Think about this too, Tim. If you go out and borrowed, let's say, banking dollars, 5 years ago at 5%, those rates are getting ready to change to 8.75. I get it if you've gone to RCN Capital, for instance, and gotten a 30-year mortgage, it's fixed. It's just, what's your back-end goal, and does it work with a mortgage loan or not? If you're going to rent the house out, great deal. Rents have gone up a little bit, those kind of things, and can you maintain all of that? But you watch the evolution along the way, and I try to, in fact, I'm doing a seminar this evening on creative financing, and part of this is going to be talking about the past a little bit. You have to watch the markets and understand things change and things will change. You get into these recessionary times, you get Washington the way it is right now, what the heck's going on, and I don't know what's going to happen coming up. I don't usually say the word spooky. I don't get spooked too much in things, but it's the unknown that scares you. And you have to expect and anticipate things to happen and be prepared to handle it. And what scares me is I would bet you 85 to 90% of those real estate investors in the industry today weren't around back in the 90s or the early 2000s.
Oh, it's more than 85%.
And all they've seen is this slow upward climb of values with rates being low. And now you get this inverse. And they're going to go, what do you do? How do you handle this? And you've got to be prepared to handle that. And you've got to think through it. And I know you always hear me say, do the math, run the numbers. It's all about the numbers. But you also have to project as to what could or could not change along the way, because it will change. I tell my office this all the time. It's like, guys, we need to be thinking about eliminating debt and paying things down because this is going to happen. And no one ever wants it to, but it does. And so it's kind of fun in a sense to go back and look historically at things that happened. It gives you some guideposts on how to move forward to a certain degree, but it also teaches you to be a little bit more conservative. Because I go back to the 08, 09 days, we were rocking and rolling. It was fun times. And we didn't expect the whole world just to stop overnight, but it did. Literally just boom. And you want to go, wow, I don't ever want to go through that again. And how do you protect yourself without being, you can't be scared to death of your own shadow. Right. You got to get out there and you got to do business. It's just, you got to rethink things and retool them a little bit, I think.
So we're going to take a break, and I want to talk about rethinking things and a whole host of other things that you just said. So stick around. We'll be right back.
Are you looking for fast funding for your next fix and flip? What about leverage for your next long-term rental or vacation rental? Need capital for a new construction project? Look no further. RCN Capital has you covered. As the leading nationwide lender for real estate investors, RCN Capital offers short-term and long-term financing solutions for your next investment property. RCN Capital takes a common-sense approach to your loan request, offering high leverages and low rates backed by superior customer service. Whether you're investing in single-family properties or multifamily properties across the U.S., RCN Capital has funding options for you with no hoops to jump through and quick closings in as little as 2 weeks. Ready to get a quote for your next investment property? Visit rcncapital.com/podcast to apply today. There is no fee to apply. Again, that's rcncapital.com/podcast to apply today.
Welcome back to Uncontested Investing. Tim Harridge here with my mentor, Scott Horne. Don't forget, click below, like, subscribe, rate, review. Let us know what you think. Scott will look at these questions on the YouTube channel. We'll get him to answer. Scott, you said rethinking things. In 2009-ish, I owner financed a lot of my rental properties because it was the only way to make money in 2009. But I kind of swore that off. I said, oh, no, I'm after equity. I'm after equity, and you lose equity. Owner finance notes are a declining income stream with a declining asset base. And I don't want to start that argument right now because I'll win. But mainly, I owner financed a house here recently, which is the first time in 10, 15 years. And we're using your services to get it closed. But it was interesting, the reasons I did it. It didn't fit my long-term strategy. It's in an area where I feel like values may have kind of petered out a little bit. I've captured $100K or so in equity in 3-4 years. It's kind of take my chips off the table and then go redeploy them. But you talked about interest rates resetting. If you took a 3-year ARM or a 5-year ARM, or you're at a bank where you've got a 3-year fixed and then adjustable rates, there's some problems coming. And you'd mentioned the commercial world being a disaster. I'm all over the place just trying to set you up because I'm going to wind you up and let you go. A lot of multifamily is on bridge loans, and there's a problem coming there, just like in the late 80s. And, there's a lot of rumblings about commercial real estate problems that are coming due. Let's rethink things and maybe touch on different strategies and different things that you see some of the customers that you work with kind of deploying in their businesses today.
So I'm still seeing in the wholesale world unrealistic numbers. Looked at a deal yesterday where we were 50,000 apart in pricing. Their ask and what we could offer to make it make sense, because they were so unrealistic in the repair takeoff. And they don't understand that, as I said earlier, when you are using the same numbers, apples to apples, you have to be at 70 cents on the dollar instead of 80 just to break even. You've got to think that way. Now, would someone come in and buy that and pay all cash for it? Maybe. Could they still make a return on investment? Sure. And there may be a lot of people who do that who are just looking for a return. But if you're in the industry where you're doing volume, we're not sitting on piles of cash. And if you are, please call us. We'd love to know about that, right?
Right.
Maybe I should have married better. Maybe I should have done this better or that better.
Oh, Susan's a great lady. Don't say that out loud.
No. I'm just saying, how do you, and I don't play the lottery, damn it. So we don't have those piles of cash. So you got to go out and get them through private capital or through institutional capital of some type out there to get it. But the numbers are going up and it forces you to buy less, which means you have to work harder to get those deals. So when you look at that, it means there may be fewer deals out there to get until the market shift changes a little bit, which I think is forthcoming. So the other philosophy is, you go back, it used to be we were an equity buyer always. We would buy houses at 50, 60 cents on the dollar back in the day, maybe 70 on the high side. I miss those days. I know you do too. And so today, sometimes maybe you need to change that shift to a cash flow mechanism. And again, I go back to a buddy of ours, Eddie Speed, who made a comment a couple, 3, 4 months ago to me about the marketplace, where 8.8% of the Texas population are in default on their home mortgages, and 30% plus are in forbearance.
Okay, so I'm going to stop you right there. I don't think those numbers are right. But in April, the HUD rule from last year, or the HUD temporary rule from last year, becomes permanent, that modifications on FHA and HUD loans can now be 40-year loan, 40-year mods.
Totally changes.
So that's now permanent. And if that's permanent, anyone that goes into default, not anyone, a lot of people that go into default are now going to have some options that didn't exist before. And you and I both know the way this works in the capital markets, the secondary market, is once that's been done for a couple years and they have data on it, next thing you know, Rocket Mortgage, Quicken Loans, they're offering 40-year loans. Is that where we're headed? Is that the only way things become affordable again?
Well, maybe. I don't know. I would never take out a 40-year loan. That's probably one of the worst financial decisions you could ever make. All somebody has to do is look at a 30-year mortgage rate and a 40 and see how small the payment difference that is between that versus how much more interest you're going to pay. And you're going, if that's all you can afford, you don't need to be buying a house right now. You need to put it off until your income increases a little bit or reduce your debt a little bit so you don't get screwed with that 40-year mortgage out there. Because at the end of the day, only the lender is going to make all the money, which is what and there's some spooky things, Tim, we could talk about
the second time you've said spooky.
What they want to do, who wants to own what from a housing perspective, and that gets a little bit way too conspiratorial. But
we'll skip that part.
Is there a plan on that or not that they want to do? I don't know. I think 40-year mortgages are terrible. I don't like 30-year mortgages. And I see a lot of more people out there who want to do that in order to capture the cash flow and let the market, vacillate the way it is. For instance, Tim, if you have a 30-year mortgage and you're renting your house, I know you're paying your debt down, you're generating cash flow. The value of your house as the market goes up, but when it goes down, right?
Yeah, but if I bought that $40,000 house in 1990.
That's 1990, though. What if
Wait.
you bought it today?
Well, when I look at the 50-year chart of the median sales price in the United States, it always points up and to the right.
It tries. But
Always.
I watch it vastly.
A year or two. That's what I'm saying. Anyway, I don't want to start an argument, but I think it depends on if you're in it for the long run or the short term, right?
Well, the question is going to become is, what's your point in life? What's your age? If you're 20 years old, different philosophy.
Correct.
As you get a little bit older and more seasoned, things change from maybe an equity to a.
So are you older and seasoned now? Are you seasoned? Is that like a marinade or what?
And I have marinated very well, by the way. No, a lot of people disagree with that, but there's always different philosophies in business. We have changed our business philosophy to more of cash flow right now, but then of equity that you would get in. At your age, Tim, I'd still be in the equity game. In fact, we were back then.
Right.
If I was 25, I'd be in that game too. And you have to approach it that way, but you have to anticipate the changes in the markets that can happen out there.
You've said a couple times, Scott, you've said this 4-letter word that starts with an M, math.
Mm-hmm.
And one of my earlier memories with you was you had that HP calculator, and it was in a leather case. I think it was like your dad's or something. You'd had it forever.
Got it of it.
You got it over there?
I do.
What type of HP is it? I forget.
12C.
A 12C. And anytime I'd be talking to you, I would have this great idea, and I'd come into your office, and you'd whip that calculator out and just start like punching those numbers so fast. And you're like, no, that doesn't work. It's only a cash flow of this, and it's a 10-year pay down, and you can pay down an 8. Like, you were always about like figuring out the math of we can get a 10-year loan and pay it off at 8. We can get a 30-year loan and pay it off in 20. You were all about reinvesting the cash flow into the equity and then doing other things to make income. Am I saying that right?
You are. So
Where did that come from? Because it's very rare.
I have no idea.
I believe
You probably. I believe you generate wealth by having assets that are debt-free. Yes, you can generate cash flow, but you also generate wealth by holding assets that are debt-free that somebody else can't take away from you. Because so often in the industry, especially in the commercial banking world, these are demand notes that can be called due at any time.
There's a lot of people that have taken a lot of demand notes that don't understand.
Yep, that for any reason at all. And I've got a bunch of them still. I don't foresee that ever happening, but back in the 80s, when I went through the crash of 86, 87 or so, and when you're young, you're stupid, you have no idea what's going on until you look back and go, wow, calling fully performing loans due just because they didn't think the value was there.
And by the way, like we didn't talk, so all these bank collapses, a lot of it has to do with mark to market on underwater assets. And I'll never forget April 08, the First Bank of Canyon Creek called me and called all my notes due. And they were performing notes.
Yeah.
I was on time, current, fully leased. It was the one that you want to keep on the books. But what I found out 5 years later is the people that weren't paying got workouts, right? They didn't get their notes called due. They called mine due because they figured, number one, I had a lot of equity, and number two, they figured I'd find a way to pay them, which I did. If you're listening out there and you're thinking, well, that won't happen to me, my notes won't get called because I make my payments. Sometimes it's the opposite.
You go back to that time frame, right? And you look back 5 years hence, as you just said, what were they doing? What they want to do? What we didn't realize also is the Fed had come in. They were sitting in the back office directing traffic. So what happened is the relationship that you had built with your banker over the years, even though you were performing, the Fed said, go do this. And it's like they say jump, you say how high, and it rolls downhill from there. And you have to do it. And you're going, but my deals were great. They were performing. I was paid current. It doesn't matter. they have the ability to come in and do this kind of thing.
And also, I heard on Bloomberg yesterday or today, one of the reasons that these banks are failing and other banks aren't buying them is with all the regulation from 08, 09, what came out of that is if I go buy your $200 billion bank, now I've got a whole lot of hurdles I have to make my entire portfolio meet. Like, it's not just fix what I bought from you. You're with the poison I bought kind of spreads through the entire balance sheet, if you will. So there's a lot of those underlying things that are in the background, like you said.
But, you know, to be a student of our industry, these are the things you have to think about. And by the way, if you don't even know about it, you don't know about it until you hear about it. But you have to go, what can happen, what does happen? And you go, my loan is performing. Why am I having to do this? Well, it's not necessarily because they did a workout for everybody else, but maybe the Fed's going, they want you to do something different. And you don't even know about it. They can't tell you about it, but it is what it is. Right. And, you know, I've talked to a couple of my bankers here in the last few days with all the bank crap going on in the industry right now. None of my guys play that game. Their money is not invested out there. You know, my average loan to value today is 56 cents on the dollar at my banks. It used to be 70. That's on acquisition. Now, my average overall is much lower than that. That's the acquisition price. And I might have some private capital I borrowed as I bought that particular asset, but I make an effort to reduce that debt as fast as possible. So when there is a change in the interest rate, my loan to value is so low, yeah, there's an effect, but it's not huge. And if you get overcapitalized and they make changes, it'll kill you. And so it's all these things together. And, if I was a young investor out there right now, I'd be going, I got a lot of homework to do. I need to be thinking through some things, find people who are seasoned like yourself, us, where you can get some information about this that just allows you to think a little bit. And instead of this world that we saw so long, you go back, for the last 2 or 3 years, it was this turn and burn economy, especially here in DFW. The wholesale game, all these explosions, these big guys just rocking and rolling, it seemed like. And it was just like, it'll never end. Well, it's ended. And things just change out there. And you have to retool that thought process and refocus a little bit. And it takes a knowledge base of where are we today, what could happen going forward, what used to happen, and how am I going to navigate this so I don't jump into something and get slaughtered. And I get it. If you're in the wholesale game where you're simply in and out, got it. You don't have to worry about it so much. But that's a job. You're not developing that long-term recurring cash flow that you've done so well at in creating those opportunities where you don't have to worry about those things right now. But so many people in our industry, they treat this as a job, not as investing. And you got into this business eventually as an investor, and you're investing long-term, and you've developed that long-term recurring cash flow.
Ultimately, that's why I gravitated towards working with you. I mean, I met you at the RIA, the old Aereo meeting at the DoubleTree.
Missed that day too.
And, I saw this guy that was building long-term wealth and was willing to share and talk to me, which, frankly, you paid it forward, and now I share and talk to people and help them. And so kudos to you for that. But, I always knew like long-term wealth was kind of, that's where it was.
Yeah, but all you want, though, is you want money in your pocket. And
I still want that.
We all do. But as a young investor, it's learning to meld the two equations together.
Eddie said it best on my show. He said there's transactional money.
Him on here?
He was one of the first ones. Season 1. He said there's transactional money and there's wealth. And if one's growing faster than the other, you're growing in the wrong direction. And I felt it was a really astute thing because you do want to raise your standard of living and provide for your family and take care of things and be rewarded. But if you let that grow a lot faster than this, then eventually, what you say earlier, something's going to go away. And if you don't have this to
fall back on,
count on, whatever, then you could be up creek. We're going to take a break and come back. We're going to get our map and our compass out. You talked about navigating what you're going to do from here on out. And I really want to spend kind of our last 10 minutes talking about that. So stick around. We'll be right back.
REI Inc. is a monthly business publication for real estate investors, covering all types of real estate investments and strategies. It is the most comprehensive real estate investment publication on the market. All of the articles are written by the top leaders in the industry, so investors are assured of always getting the best information possible. Each month, REI Inc. also profiles the top companies in the industry and provides insights and data into key regional markets. Along with their sister platforms, the REI Referral Network and Highest Invest, real estate investors have exclusive access to off-market investment opportunities and national acquisition and disposition initiatives. To learn more, visit www.rei-inc.com, where you can also access the REI Referral Network. Also, be sure and visit www.highest-and-vest.com to view the latest exclusive off-market assets with near immediate acceptance decisions and closing strategies. You can also email marketing@rei-referralnetwork.com to request more information.
Welcome back to Uncontested Investing. I'm Tim Harrods. Thank you for sticking around. I'm still here with my mentor, Scott Horne, but don't forget, click below, like, subscribe, rate, review. Let us know you're there. Ask Scott questions. We'll get him to hop into the YouTube video and answer questions. Scott, we're going to do the money minute, and then we're going to go talk about navigating. So this is going to be virtually impossible for you. 60 seconds or less. Imagine there's a young Tim Harrods out there. I've seen you take so many young investors under your wing. There's a young entrepreneur, a young investor out there, and you're only going to get 60 seconds of advice in the next 30 days. This is it. This is the go juice. This is what you got to pour into them. You can't scare them, and you don't want to over-motivate them. You got it?
Got it.
Go.
So my advice is, one, don't quit your day job. Be willing to put the time and effort in to make this happen. Your day job may be in the wholesaling world where you're actually generating an income and those kind of items, but find a mechanism to start buying and holding at least one house a year. That's all you got to do. Learn the financing techniques and how to do that, how to reduce your debt, generate income to live on, and then buy and hold and start generating this long-term recurring cash flow.
So some of my greatest struggles in 2005-ish was when we had Sprint Partners LP and we were making a bunch of money. And you came up with this cash formula of the top 20% for advertising, the next 30% for, you called it the kitty, right? And then we would distribute the 50% of what was left on the wholesale stuff to me, you, and Dave, and Dwayne. And I just remember thinking, man, he just doesn't want me to make money, But it's been such a valuable lesson for me. And what you were really doing was budgeting for overhead and G&A and contingencies and all these things that they teach in business school, but I didn't have business school, right? Like that. And then we had enough money that we started buying notes or keeping houses as notes. And the company was self-funding because we had put money back. And then 08, 09, this is, I guess a compliment, I don't know. Jennifer and I built the big $1 million house, and we were trying to get out and refinance. The world went to heck. The only loan we could get was a $417,000 FHA loan. And the only way to get that done was to take a buyout on the note portfolio, because we had to bring hundreds of thousands of dollars to the closing table that we didn't have. Yep. So it was literally foreclosure or liquidate notes. Part of me kind of wishes I hadn't had to do that, but at least I had it there to do it. And so, I mean, thanks for that. But that advice you just gave kind of ties into that, right? You never know when you're going to need it, but by God, if you have it, at least when you need it, you can get it.
Well, one, it's nice to have that. Two, I didn't have business school either. Mine was the school of hard knocks. and you learn, you hope you learn to be wise in this business, and you have to think that way. And I want to say one thing that's kind of fun, Tim. I go back to the day we met, and you picked the phone and you called me, goes, I want to go to lunch. I'm going, why? So we go to lunch that one day, and you go,
Creek barbecue.
teach me how to buy one house a year to what you do. Lo and behold, I had no idea the next day you're going to call and say, I want to come work for you. I'm damn glad you did. One of the best moves ever. It was awesome. It was fun. It'd be fun to get back and do those kind of things again, too. But learning how, again, so many people, they want instant gratification. They want, in our whole economy, the whole world's that way. They want everything now. And I get that. We all want things now. But if you are not forward thinking enough to put something back and to start that growth curve, you will never have it because you're going to blow everything. It's like, I was reading, my daughter asked me a question about investing and whatnot out of the blue. It's like, wow. I kind of like that.
It's amazing she asked you that and didn't just go to Bigger Pockets and figure it out.
Yeah. But she asked a question, and she asked, what do I read and whatnot? And one of the books, of course, is The Millionaire Next Door. And I was looking up some stuff online about that, and it was just like the differences in people. The millionaire next door drives the used car. The one that doesn't have any money drives the brand new car. And all these little nuances like that, and they really do make a difference. Now, at some point in time in life, when you have it made, it doesn't matter, do what you want to do. But you have to get there first. And so many people are not willing to pay the price to get there. They want it now, today. And so going back to the young investor in that 60 seconds, we'll go an extra 15 seconds. Be smart. You have to put away for the future because things do happen in life, just like in your scenario. And we were very fortunate to be able to do this kind of things. I didn't want that to happen. You didn't want it to happen. But you know what? It is what it is. Life happens, and you deal with it. Fortunately, we were all smart enough to do those kind of things. That made life a little bit easier and allowed us to do some things. I get it. And sometimes you do what you don't want to do. And you move on. And you rebuild again. And don't get stuck in this investor paradox. Sometimes you just got to get out of your deal and go live to invest another day. It's okay. If you lose a bit of money, lose it. Don't risk the foreclosure or something. That's going to really mess you up, right?
And you're going to lose it still.
You're going to lose it. Yeah, absolutely.
So we're almost out of time, and this is where I'm almost afraid to ask it, but I ask it every week, so I'm going to go ahead and do it. Do you have any parting thoughts or parting shots?
I just think that there is going to be a quantum shift in our marketplace, not as bad as 08, 09. I think there's going to be a lot of people hurting who need to get out of their houses. And there's an opportunity there to take advantage of some of these low interest rates, learning the creative finance game a little bit. Just because as bank rates are going up so much, maybe that's a suggestion. The problem with that is it takes cash to buy those properties. And oftentimes it's a cash flow game. It is not cash flow today. It is very hard to do that. And I think learning some different techniques so you can take advantage of things when they come across your plate is valuable in that regard. The other thing I'd say is finding a mechanism to create multiple streams of income, whatever that might be, is valuable. I've been very fortunate to have done that. I wish I could say that I planned all of that because I did not. Things have happened. I've been just blessed beyond, imagine to be able to get there to do those kind of things. But because of that, it now allows me to invest and hold long term, which does generate that, as we call it, generational wealth down the line.
Right. Well, Scott, I mean it when I say it. Thank you for being here. And thank you for all you've done for me in the last 20 years. And I intend to continue to.
You're going to make me cry, man.
Well, you're getting old. I intend to continue to ask you for things as we navigate this time, right? Because this time will be different than the last time. And if you're out there, the next time will be different than this time. But the one thing for sure is things will change. So thank you for being here. If someone wants to get a hold of you, do you even know your social media handles? If not, we can wait and have Susan put them on the screen or in the show notes.
Yeah, my mom put them on the screen. So Horne and Associates PC is our law firm, HorneRealEstateLaw.com. First Option Title is our new title office. We'd love to work with the investor marketplace out there.
Is that just Dallas-Fort Worth for now?
It is for now. It's going national. You don't know that, do you?
Did not.
Yeah. theownerfinancenetwork.com, which is the vertically integrated entity for the creative finance world. Those are probably our three main ones at this point.
Goat Funding, your hard money. Is it hard money private lending? How do you characterize
It's Goat Funding. GoatFundingGroup.com is the email address, and that's our asset-based lending arm. Back in the game, but Tim, I'll tell you, I don't ever want to be as big as we used to be. Not at this point in time right now, but it's a slow build where we love to work with new investors to help them be successful in the business.
Well, we'll get the social media handles from Susan and put them down in the show notes and put them on the screen. I appreciate you being here. We are out of time. Thank you for stopping back by this week. Remember, your network is your net worth, and today you've been growing both. We'll see you next week.
Thank you for listening to the Uncontested Investing Show. Questions about today's episode or the podcast? Email podcast@rcncapital.com and make sure to follow RCN Capital on Instagram, LinkedIn, and Facebook. See you all next time. The preceding program is furnished by RCN Capital, LLC. The information provided is for general education purposes only and does not constitute any legal, financial, investment, or other professional advice. The views, thoughts, and opinions expressed by any speaker are the speaker's own opinion and do not represent the views, thoughts, and opinions of RCN Capital, LLC. No information contained in this episode should be construed as financial, investment, or legal advice from RCN or any individual, author, host, or guest. You should always consult a financial advisor before investing.